In the orthodox textbooks of finance, the stock market is described as a rational, cold calculator of economic value. We are told that prices move based on quarterly earnings, balance sheets, and industrial productivity. But if you look behind the digital screens and analyze the raw behavioral anatomy of a market crash, you will discover that the global financial system does not trade assets, it trades human emotion. Welcome to the ultimate business blueprint of emotional arbitrage. In this arena, the greatest wealth transfer in human history occurs not because of technical algorithms, but because of a psychological divide between two distinct classes of capital: smart money and dumb money. Smart money represents the institutional elite, the sovereign funds, and the ultra-wealthy who operate with absolute emotional detachment. Dumb money represents the fragmented mass of retail investors who enter the market driven by FOMO, the fear of missing out, and exit driven by raw, blinding panic. The entire structure of Wall Street is deliberately engineered to exploit this cognitive asymmetry. Volatility is not an accident or a market failure. It is a feature designed to strip the retail investor of their capital. When markets surge, the media machine pumps euphoria into the public consciousness, baiting dumb money to buy at the absolute peak. Conversely, when the market drops, the exact same machine engineers a landscape of capitulation, causing the retail crowd to sell their assets at a catastrophic loss. This is where smart money strikes. They do not buy when it is safe. They buy when there is blood in the streets, absorbing the panic-sold assets of the masses at a steep discount. They understand a fundamental psychological law of wealth. Money flows from the impatient, the emotional, and the insecure into the hands of those who have mastered the art of calculated patience. To understand the anatomy of financial slaughter, one must first study the architecture of euphoria. No trap can succeed without a compelling bait, and in the global markets, that bait is the illusion of effortless wealth. This is the business blueprint of the Euphoria Engine. Every major market bubble, from the dot-com crash to the contemporary speculative manias, follows a precise psychological script. At the beginning of the cycle, smart money accumulation happens in absolute silence. But as the asset price begins to climb, the media apparatus is systematically activated to broadcast a highly toxic narrative to the masses. The lie that, this time, it's different. This is the birth of the retail FOMO phase. The human brain is evolutionarily hardwired to avoid social exclusion. Watching your neighbor get rich while you sit on the sidelines triggers a profound neurological pain. The market masters understand this vulnerability perfectly. They pump the digital ecosystem with stories of overnight millionaires, driving the retail crowd into a state of hyper-arousal and cognitive blindness. Rational analysis of valuations, cash flows, and macroeconomic indicators is completely discarded, replaced by raw greed. The retail investor no longer buys an asset because they believe in its structural value. They buy it simply because the price went up yesterday, blindly assuming it will go up tomorrow. They willingly take on massive leverage, max out credit lines, and pour their life savings into the market at the absolute mathematical peak. What they fail to realize is that their massive, late-stage buying pressure is the exact liquidity the institutional elite requires. The euphoria of the crowd is not a sign of a healthy market. It is the final green light for smart money to distribute their assets and quietly exit the building. Once the institutional elite has successfully distributed their overvalued assets to the euphoric public, the market matrix shifts instantly from a landscape of dreams into a hunting ground of terror. This is the business blueprint of the Capitulation Trap. The very same media apparatus that just days ago promised infinite gains now pivots to architect an atmosphere of total financial apocalypse. Headlines scream of structural failure, imminent collapse, and systemic ruin. The psychological goal of this phase is absolute and singular: to break the emotional spine of the retail investor. When a market begins to bleed, the psychological pain of holding a depreciating asset triggers a deep, existential survival mechanism in the human brain. Retail investors watch their hard-earned capital evaporate day after day, entering a state of cognitive paralysis. The market masters deliberately amplify this pain by triggering calculated margin calls and driving prices past logical support levels. This is a cold, mathematical hunting strategy. As the red candle charts plummet, the emotional pressure becomes physically unbearable. Finally, the retail crowd reaches the breaking point: capitulation. Driven by the primal urge to save whatever is left, they sell their assets at the absolute bottom of the cycle, absorbing catastrophic losses. What they fail to comprehend in their state of terror is that someone must buy what they are selling. At that exact microsecond of total retail surrender, smart money is waiting in the dark. They are not panicking. They are greedily placing orders, capturing pristine, high-value assets for pennies on the dollar from the very hands that bought them at the peak. To survive in the brutal ecosystem of global capitalism, one must learn to look at a financial crisis not as a tragedy, but as a severe mispricing of human life. While the retail crowd is paralyzed by the crimson flood of a market crash, the institutional elite, the sovereign funds, the dark pool operators, the architects of smart money enter their most disciplined operational phase. This is the business blueprint of the accumulation zone. To the untrained eye, a bear market looks like a barren wasteland of economic ruin. To the master of capital, it is a pristine, silent supermarket where the crown jewels of global industry are being sold at a 70% discount. Smart money operates on a psychological frequency that completely detaches price from current headlines. They understand that value is structural, while price is merely a volatile reflection of short-term human insecurity. When dumb money is desperately liquidating their portfolios to pay off high-leverage margin debts, smart money establishes what algorithms call the Iceberg Orders. These are massive, multi-billion-dollar buy orders broken down into thousands of tiny, invisible fractions, systematically absorbing the panic selling of the masses without moving the price needle. They do not want the market to realize they are buying, they want the panic to continue. They actively engineer a prolonged landscape of exhaustion, keeping the market depressed for months until the final retail investor loses all hope and walks away. This is not casual investing. It is an industrial, calculated accumulation of structural wealth. By the time the macroeconomic news finally turns positive and the media announces that the economy has recovered, smart money has already locked up the float, owned the bottom, and prepared the stage for the next massive generational breakout. When the final drop of retail capitulation has been absorbed, and the float is firmly locked within the vaults of the institutional elite, the market matrix prepares for its final, most spectacular illusion: the rebirth of capital. This is the business blueprint of the generational breakout. Slowly, deliberately, the macroeconomic narrative begins to shift. The media apparatus, now cleared of its apocalyptic headlines, begins to whisper stories of recovery, technological breakthroughs, and green shoots of economic growth. The price of assets, no longer weighed down by the panic selling of the masses, begins a steady, unyielding climb upward. As the chart lines break through historical resistance levels, a new generation of retail consumers opens their laptops. They are fresh, unscarred by the previous crash, and fueled by a newly awakened primal desire to participate in the rising tide of wealth. The infinite loop closes. The very same assets that smart money acquired for pennies on the dollar during the depth of winter are now repackaged, rebranded, and distributed back to the public at an astronomical premium during the height of summer. This is the tragic, eternal asymmetry of global finance. Dumb money buys the top because they chase validation. Smart money owns the bottom because they possess execution. This is not a system broken by flaw. It is a system functioning exactly as it was designed. Rulers change, regulations evolve, and new technologies redefine the digital interface, but the fundamental architecture of human psychology remains immutable. The blueprint is complete, the cycle is eternal, and in this grand amphitheater of capital, the emotional pay the tax, while the disciplined collect the dividends.